good time to get started here. Hopefully everybody can hear me just fine. If not, feel free to shoot me an email or put into the chat if you're having any difficulties technically. But yeah, let's get started. So thanks everybody for joining us. We're excited to be doing this again, albeit with a little bit better technology. Previously just doing the conference calls. Nicer to have a webinar here in case we can share things and do live Q&As in the future. So we're excited about a few of those items that'll be forthcoming on future calls. Hopefully everybody's doing well, safe, happy, healthy, enjoying their summer. Wanted to make a couple of quick announcements before we turn over to the primary agenda for today's call. So aside from these calls, we're planning to publish a lot more client content going forward, that all of which will be available on the website. So keep an eye out for a few of those items. Next month, we'll be starting the first series of a newsletter with company updates, important client reminders, things of that nature. We'll also be posting some videos and eventually getting a podcast started for some quick hitting information around timely topics, in addition to just these calls so that people can access that information at their leisure. As always, we're going to try and keep this brief, 15, 20 minutes. I'm going to turn it over to Matt in just a moment. As you can see, I'm joined by both Aaron Marks and Matt Liebman on this call. We'll do some market commentary and some Q&A that's been curated from what we've been hearing from clients the last few weeks. But just a quick couple of operational announcements before I turn it over. First of which, you've probably been getting a lot of stuff from us from communications via email, in addition to just our one-on-one conversations. Just a quick reminder on our client portal. Some have already logged in and gotten started. If you have not received an invitation yet, it will be coming over the next couple of weeks. Feel free to reach out to us with any issues there. In regards to how we'll be using the portal, there is no obligation for you to be logging into the portal on a daily basis, but we will be using it to post quarterly portfolio updates, in comprehensive financial planning information, and other legal documents from a secure sending standpoint. In terms of other important updates on our end from an operational standpoint, we did just bring on a new team member, Jonathan Bass, you may have seen on LinkedIn. So if you get an email or hear from John, it is not a phishing or scam of any sort. He is an official member of Amplius. So feel free to give him a warm welcome if he does reach out. But with that, I've rambled enough. I'm going to turn it over to Matt and go back to mute. Thanks.
Thank you, Pat. And Pat, just give me the thumbs up. You can hear me okay? All right. So first, just wanted to say thank you and welcome to everybody who's on the call. Exciting to do this for the first time from the other side, since we got this all set up. And given that this is our first of these formal calls, even though we've all spoken over the last 3-4 months since starting this, just wanted to just give a thank you again to all of you for making these first 5 or so months of our new company a success, and not only for your support, but also let's be honest, for your patience. It was the paperwork and technology lift has been significant, and we're the good news is the investments are in good shape, and I think when you review your quarterly performance reports, we can discuss that. But I think you'll be largely satisfied there. But again, thank you for your support and for your patience. Just owing to the format that we've always done on these, I'm going to just give a little bit of a market year-to-date update and snapshot that my father and I have been discussing this morning, and then looping in Pat and Aaron, and maybe on one of these future calls we'll actually get my father up here, and then we'll really have some fun. But just a couple remarks about the markets, and then we'll get to again some of the Q&A that we've gotten from you over the last few weeks. In terms of stocks, they are off to a strong start for the year. We're now about give or take 16 months on from the initial COVID diagnosis and in the U.S. and then the subsequent economic shutdown and the market reaction and the depths of that. We've long since recovered the COVID sell-off in the equity markets. And primarily, it was interesting for at the beginning of the year and the last quarter of last year, we started to see a bit of a reversion and reversal of some trends that had been out there for a long time. And that was value stocks finally started outperforming growth stocks. There were a couple months in there where international actually did better than many US indices, and small caps were really running higher. And in the last couple of months, we've reversed right back to where we were. In terms of growth is outperforming value, US is outperforming foreign, large is ahead of small. I guess the good news is that everything is up. But I think from a market health standpoint, it would be nicer to see more breadth like we were seeing earlier in the year with various parts of the market doing well, not just a couple segments. But we'll get to that in some of the Q&A. But in general, really solid start to the year for stocks. Much more of a mixed bag for bonds. Munis have held up reasonably well. That is often the largest bond holding of the high net worth investor, and they've done reasonably well. Taxables, not so much, down a little bit on the year, but nothing atrocious or scary or terrible. But as rates have gone up a bit this year, they've certainly tapered off the move that had started. But as they've gone up a bit this year, it's been a rather mediocre or lackluster start to the year for bonds. But again, nothing particularly disastrous there. And then on what we would loosely call the third category of investments, general alternatives, which are harder to aggregate and discuss, sort of as a monolith, even harder than equities and bonds. But what we've seen there, and I'm sure you've all seen this either anecdotally or professionally, depending on your chosen profession, real estate has had a heck of a run, especially residential in a lot of suburban communities. You're seeing a lot of large private equity deals, still a lot of money out there. And then also in the alternative space, and I know a lot of our business owners on the call know about this because we've talked about it, particularly those in the manufacturing sectors. Commodities have had their first rally in a long time over the last 12 months or so. For the better part of, let's say, 2008 through 2019, commodities were a pretty lousy place to invest, but kept costs low for a lot of businesses, and that has sort of reversed a little bit as they've caught a little bit of a bid and gone higher in terms of prices as the supply-demand dynamics have changed over the last couple quarters. So, that's just sort of our synopsis of where things have been. In terms of where they are going, we'll dust off the crystal ball, but I'll turn it over to Aaron, who has curated some questions from you, just or from all of you. We've all curated just questions we've been getting on the phone and such, and he's put them into a list. As Pat mentioned, in the future we'll have more live Q&A. But Aaron, why don't you start there, and we'll use that to guide the conversation going forward.
Sure. Thanks, Matt. And thanks for everybody for joining. So the questions that we came up with today are what we talk about internally, what we're reading about, but also the questions that we hear a lot from clients. So we figured we'd expound a bit more on them. So first, Matt, a lot of conversation recently has been around interest rates, inflation, whether higher or lower, where's it going? So what's your view there on where rates and inflation might be going? How are our positions? How is our portfolio positioning, taking into the account those views, and how might that change in the future?
Yeah, this is probably the hottest debate topic right now in let's say market economy. I'm sure there are some political topics that are debated more often, but is inflation, which we've seen at a higher level than at any point really in a long time, decade plus, is it transitory as some more sanguine folks, especially at the Fed, have suggested, or is it here to stay, and even could it get worse, and what are the ramifications of that? I think we're reasonably qualified to make comments on that, but I'll defer to the Fed, that they have a little bit more training in the area, and generally they are in the camp that it is at least partially transitory. That is that inflation, which has been running hot over the last couple readings at about 5% or so, will come back to earth a little bit, and so our general view is, while inflation will not stay at 5% or even go higher, it's probably not heading back to 0 to 1% or 1.25% like it was for a long time over the last few years, but will settle in likely above the Fed's comfort target of above 2%. How we're dealing with that now in the portfolio and what we would do going forward, really, to me, at the current time, given that we don't think it's going to be huge, we don't think the impact will be tremendous on the stock market. You might favor some sectors over others. For example, if we thought interest rates were going to pick up a little bit more, you might favor financials, that would benefit from that higher interest rate spread, and you might lighten up on tech a little bit. We may do some of these things because a lot of tech companies are discounted using prevailing interest rates, so the higher rates go, the lower multiples on tech companies. But I think the bigger impact will be on the other side of the portfolio. And so for one, we do not like long-term bonds, and we don't want to own them. I'm not saying rates are going way higher, but they don't have a lot of room to go way lower at the long end. So where we have bond exposure, we want to keep it pretty short term. And where we use alternative investments also plays in here, whether it's some protected structured notes that we're looking at that we'll be in touch on, or commodities or other alternatives. We'd be more likely to use those right now in place of bonds, particularly long-term bonds, rather than in place of stocks, and because we think they can be a reasonable inflation hedge. So long answer there, Aaron, but generally we think inflation is here to stay, but not as ugly as some forecasts, and it would just lead us to lean against long-term bonds and maybe make some subtle tweaks to the equity portfolio. I think you're muted, Aaron.
Thank you for telling me. So with headline risk, whether it's what you mentioned with inflation or interest rates or COVID resurfacing in a meaningful manner and putting us back into hibernation, do you think we're due for a pullback? And if so, what actions do you think we'd take and pull back in the equity markets? I mean.
Yeah, right. Tough call. Long-term forecasting is hard enough. Short-term forecasting's, in some cases near impossible. But I'll do my best here. I think we're more due for a number of the reasons you mentioned. Be it politics. We could get some bills out of Congress, or hopefully COVID with this Delta variant or other variants doesn't get too bad. But it's out there, and it's still here and getting worse in some pockets. I agree with you. I do not see a broad-based economic shutdown. That said, would I be shocked if we saw a pullback as the numbers spike up like we saw, what was that, 2 Mondays ago, where the market sold off maybe 800-900 points on bad COVID news? I think we're definitely susceptible to that still. If I had to guess, we will see let's say a slowing of the pace to the upside of what we've seen. I don't foresee the second half of the year being as strong as the first half, and I think we certainly could see somewhat of a pullback if we saw anything meaningful. Anything in the sort of a sell-off of 5-10% or more. I think we would use it as an opportunity to buy, to rebalance. Similar to what we're starting to do now, which is some of our portfolios and clients, their allocations have gotten above where they traditionally are because of the strength of the portfolios in the markets, and we're going to do a little selling now. So I think in general, if we saw a major pullback, we'd want to do some buying. Great.
Well, 2 more. One of everybody's clients' portfolio assets, not just stocks and bonds, but really is dominated by real estate, whether a primary home, secondary, investment property. And you touched briefly on real estate prices and the boom they've had recently. What's your view on the real estate market and where it goes?
Well, I'm certainly no expert on real estate, so I won't say too much. My number one advice would be get a good real estate agent and advisor when you're going through a transaction, because nothing replaces market knowledge there. And I was lucky enough to do that myself last year when buying and selling homes, and it worked out pretty well. And but in general, yeah, look, we've seen this huge move up in real estate. There's a lot of cash out there. It's somewhat similar to the stock market, right? It's that there's a lot of cash out there, and people are putting it to work in various places. One of them's the stock market. One of them's real estate. I don't think real estate is, let's say, much more insulated than stocks from a sell-off. I think it's going to be more regional than the stock market in terms of in terms of probably pockets that are strong and pockets that are weak. But in general, I can't imagine appreciation like we've seen in the last few quarters, particularly as rates are as low as they are now. As they start to go higher, I would think that real estate, much like equities, much like bonds, other assets, could at least slow the increase and maybe even give back a little bit. One thing I will say, and this is anecdotal, I after working about 7 days a week for 5 months, took my first vacation last week in Telluride, Colorado, which, if you get a chance, is beautiful. But if that market is any indication, the real estate market is hot, because the price per square foot out there was staggering. So anyway, my advice on real estate would be to again get a good real estate professional agent to help you, and also be careful. I think there's some pockets of overheating there, just like there are in equities and other asset classes.
Great. So easiest, being facetious here, but easiest question for last. As politics are always in the news, it's tough to know which way things are going, but a lot of conversation about tax reform, and there's a lot on the table and a lot of guessing, but where do you see things coming out with potential tax reform, and then how it affects the investment markets and portfolios going forward?
Oh, sure. Softball, Dan. And by the way, I do see on our chat here, a couple people have been lobbying some questions that we've been going. We're going to open that feature up for future calls to answer them in real time. In the meantime, I don't want you to think you're being ignored. If you've thrown some questions in there, we will get back to you one-on-one after the call on those questions. But in terms of tax reform, you mentioned, or tax policy, tax bills, who knows what they're gonna. It looks like, and I hesitate to say anything's a done deal in Washington, but it looks like bipartisan infrastructure legislation is going to go through. If I had to guess, that will become the law. And then the question is, can the Democrat Party, which has 50 members of the Senate, can they, through reconciliation, get through major spending and tax hikes between now and year end, or shortly after the end of the year? I think they're certainly going to try. If I had to guess, and this is really a guess, is they will get something passed, and it will not be it will not be everything they want. That they will not. That there are too many. Whether it's Manchin, Sinema, too many conservative-leaning Democrats that I don't think they will be able to get to 50 without paring back a little bit of the rather ambitious spending and tax agenda they had. How it will impact us a few different ways. At a market level, if the market sees major corporate tax hikes, cap gains tax hikes, income tax hikes, it may not like it, and you may see some short-term sell-offs. If we don't know that yet, though, until we see what's actually in the bill. In terms of planning, curious to see what they do on capital gains, of course, and would it make sense after years and years, frankly decades, of advising people generally leaning towards tax deferral as a knee-jerk, in conjunction with their tax advisor as an instinctual policy? Maybe not anymore. If we think that capital gains, at least for certain clients, may go up by 50% or double, from about a 20% rate to a 40% rate, certainly could be an argument for taking those gains in the here and now. On the estate tax, which I know is another hot button tax issue for our clients, it seems as if they're not going to make any huge changes to the rate, particularly given that I believe it's 2026, you get that sort of automatic reduction of the exemption without having to do anything. But I think that issue that's being talked about a lot, of whether the step up in basis stays or goes away, could have a huge ramification for long-term planning. So again, my best prediction is we get something north of nothing, but not as extreme as some of the proposals. Though that's almost my prediction for everything. I always tend to go in the middle. And then in terms of ramifications, we got to see what comes out there. But certainly cap gains and stepped up basis and such are front of mind. We want to see what they're going to do there and see how we react to it.
Great. Couldn't agree with you more. I appreciate that. And that will end the Q&A portion of the conversation. So I'll, keeping time in mind here, I'll kick it back to Patrick for some closing remarks.
Excellent. Thank you, guys. And thanks for all the smart remarks from you, Matt. I just want to mention one thing, just because I feel like it's been such a popular topic for everyone. We've had quite a few conversations around real estate. If you're considering moving, if you're looking at investment properties, et cetera, have a conversation with us. We've had a few where one of the positives right now is interest rates are really low. So if you're buying into a hot market, it could make sense to look at your options, and we'll just keep it broad in that. We've had a lot of productive conversations around that. But other than that, thank you everybody for joining. We had a great turnout from what we can see in regards to attendees. One of the things that we've said in the past and will continue to hammer home is feel free to open these up and send these invites to colleagues, friends, family members. We'll try to be more specific on items and open it up to Q&A and have even more content pumped out for everyone. We're also going to try to be getting these recordings on the website. So if you weren't able to attend, they should be on there as well for you to come back to. Other than that, thanks everybody for the support. Thanks for coming on today. Thanks, Matt and Aaron. And we'll talk to everyone soon, of course.
Thank you, everyone.
Well,